posted on the Knowledge Center if you would like to watch it again. And that is the end of the housekeeping announcements. I am going to turn the mic over to Jeff Ford.
Well, thank you, Mary Lou. And to all of you on the phone, thank you again for joining us for this fourth and final installment of the 2020 Virtual CPE series. As Mary Lou mentioned, we do have some additional presentations regarding PPP and other matters through the remainder of the year, but this is the fourth and final in our Virtual CPE Day of 2020. It's important to once again thank Mary Lou and Glenn and Carissa and so many that worked very hard to make this possible. Thank you again for your great work in that regard. Mary Lou mentioned the presentations you'll be looking forward to. In the meantime, Andy, who will be up first, will be moving the slides. So Andy, there we go. Once again, we're highlighting our 30 years, our 30th anniversary. Many will remember the party for our 25th anniversary. If we could back up to the 30th again, Andy. We really wanted to do that again for the 30th. And as Bob so eloquently mentioned a few presentations ago, we cannot overstate our gratitude for the success that we've enjoyed over these years. We're absolutely privileged to be part of such a special team within GYF and privileged to work with each of you on the call in various contexts. Especially appreciate those client and referral source contacts. All right, Andy, up to the next slide. We already heard what the presentation is, so we're going to skip right past that one and talk about our speakers for today. Andy will kick it off with an ANA update. He will hand it off to Jason, who will cover some other matters, including some new things kind of coming down the road that we'll be excited to hear. And I'll close off the first hour with a couple of topics on PPP accounting and going concern. We'll then hand it over in the second hour to Mark and Megan, as Mary Lou indicated. So with no further ado, take it away, Andy.
Thank you, Jeff. I will be discussing today at first something that we don't typically discuss in this section. It's updates to the statements on auditing standards. And the reason I'm going to be hitting on those is there's some significant changes that were made by the AICPA, and SAS 134 through 140 were issued in 2019, and they were initially effective for periods beginning after December 15, 2020, among other things, including concepts of materiality and other auditing specific items. SAS 134 and 136 are of particular interest because they change the form and content of audit reports. Following the issuance of SAS 134 through 140, SAS 141 was issued to defer the changes made to those until periods beginning after December 15, 2021, in light of the coronavirus pandemic. Early adoption of these is not permitted. So we'll start with SAS 134, and it's titled Auditor Reporting and Amendments. And there, as I mentioned, there's changes to the audit report and other communications. There's layout changes. Specifically, the one that most of you will see and recognize immediately is that the opinion was moved to the top, followed by a basis for that opinion, moved from the bottom of the audit report to the top to really pop, I guess. There's also been an expansion of the description of management and auditor responsibilities, which I'll show in some examples that I have coming up. And there's also an optional inclusion of key audit matters. And this is to conform with something the PCAOB was doing with public companies called critical audit matters, but these are not required and are only required when an audit firm is engaged to do so. So moving into my examples here, this is the beginning of an independent auditor's report. Once SAS 134 is effective, as you can see, the opinion is now first, followed by a basis for the opinion, which includes an explicit statement that we are required to be independent as auditors. And moving forward, this section here is the enhanced auditor responsibility that includes an explicit statement that we exercise professional judgment and maintain professional skepticism, and also one that relates to going concern. I know Jeff's going to talk about going concern later on, but there is also a paragraph. I'd like to note that there's also a paragraph here under the management responsibilities that talks about the management's responsibilities to evaluate going concern for the audit period and thereafter. The last item here that's highlighted on the bottom of the page is a requirement that we communicate with those charged with governance throughout our audit process. Moving on to SAS 136, This is similar to SAS 134, except it relates mostly to the employee benefit plans subject to ERISA. There were also changes to the audit report here that in a lot of cases conform to SAS 134 from an order of operations perspective, and also include paragraphs relating to responsibility for going concern. But one of the biggest changes that you're going to see here are limited scope audits are now called ERISA Section 103A3C audits, and you're actually going to see an opinion in the auditor's report related to the financial statement information other than the certified investment information. And that's different than what it's previously been. Previously, we were required to issue a disclaimer of opinion when we were doing those limited scope 401k audits. So moving forward, this is an example of what an opinion is going to look like in the ERISA 103A3C audits. This first bullet point here is saying that the amounts in the financial statements, other than the certified investment information, are represented fairly in all material respects in accordance with GAAP. This second bullet point is basically saying that the certified investment information, it meets the requirements of ERISA Section 103A3C. The next area that is enhanced here is increased wording related to the supplemental schedules required in an ERISA audit, required by ERISA. I'm not going to go through these paragraphs here in detail, but I'm just showing kind of the breadth that they went when talking about the supplemental schedules in these audit reports. The main thing that changes here as well is that there's going to be a separate opinion that's much like the opinion on the financial statements, but instead says that the supplemental schedules are in conformity with the Department of Labor and ERISA. And that brings us to our first polling question. And it says, as a preparer or user of financial statements, do you feel that these changes have enhanced the audit report? So with that, we'll move on. So there's been a few, in 2020, there have been a few accounting standards updates that have been delayed. I've noted them here, but Jason later in our presentation is actually going to discuss these in further detail. So now we'll move into newly applicable accounting standards that were applicable in 2019. And I'll go through these relatively quickly. Accounting Standards Update 2017-04 relating to goodwill, which eliminated step 2 of the impairment test. Step 2 of the impairment test was if the carrying value exceeds the fair value of a company, you need to compare the implied fair value of goodwill to the carrying value and record impairment charges for excess of carrying value over fair value. Now you're able to compare fair value and carrying values at the reporting unit level and record an impairment charge based on that comparison. This is effective for years beginning after December 15th, 2021. Early adoption has been permitted since January 2017. Accounting Standards Update 2017-07 relates to compensation for retirement benefits. This relates to employers who offer their employees defined benefit plans. And this requires that the service cost component of net periodic pension costs are recorded on the same line item of the income statement as compensation expense. All of the other components should be recorded as other income expense and expense outside of income from operations. ASU 2017-08 relates to receivables. Particularly, this more closely aligns the amortization period on securities held at discounts or premiums, and more closely aligns the recognition of interest income on bonds held at discounts and premiums. Previously, the amortization period was to be recognized over the life of the security. Now, the change in 2017-08 brought on is that the amortization period is now at the earliest call date of that security. This is effective for years beginning after December 15th, 2018 for public and 2019 for private. And this does require a change in accounting principle disclosure. ASU 2018-07 relates to stock compensation for share-based payments to non-employees. What this does is it aligns share-based payments to non-employees with that of employees of the company, and these can either be recorded as a liability or equity, depending on the award terms. Following this ASU, Accounting Standards Update 2019-08 was issued in order to clarify the relationship between topics 718 and 706 for stock compensation and revenue from contracts with customers. What this says is that the measurement of these awards needs to align with topic 718 if the awards are given to customers, rather than topic 706 or 606, excuse me. ASU 2018-08, topic 958 for nonprofit entities. This clarifies the scope and accounting for contributions received and made, and this was issued in conjunction with topic 606, revenue recognition, to determine whether a transaction should be a contribution or considered an exchange. And there's also additional guidance as to whether a contribution should be considered conditional. ASU 2018-13 related to fair value measurement. What this does is streamline and simplify fair value disclosures for level 3 investments, and also allows to report on activity of level 3 investments instead of a reconciliation of beginning and ending balances. There's also a change in disclosure for investments in certain entities that calculate net asset value. 2018-14 for defined benefit retirement plans reduces necessary disclosures for entities that sponsor these plans. Coincidentally, there are a number of disclosures that were reduced consistent with those in 2018-13 related to fair value measurement. ASU 2018-15 relative to internal use software. This relates to implementation costs and cloud service contracts and aligns the capitalization of those costs with other standards. Basically, implementation costs in an application development stage are capitalized. That'd be coding, hardware installation, or testing of the system. All other costs related to implementation would be expense, such as data conversion or training. The service element of this hosting arrangement is unchanged and is expensed as incurred. ASU 2018-17 related to consolidation. This allows a private company or reporting entity to not apply VIE guidance related to legal entities under common control. If this is elected, it must be applied to all current and future legal entities under common control that meet the criteria specifically for applying the alternative. Decision-making fees should be considered on a proportional basis with the percentage of ownership. 2018-18 related to collaborative arrangement. There was some uncertainty as to whether these transactions should be considered under topic 808 or topic 606. What this ASU does is it clarifies that certain transactions in these arrangements be recognized appropriately under 808 or 606. ASU 2019-03, not-for-profit entities. This modifies the definition of the term collections, and collections typically means collections of art, not as much collections of receivables. ASU 2019-06 is a number of topics that basically extends the private company accounting alternatives for recording goodwill. This was initially made available to private companies via ASU 2014-02 and allows you to amortize goodwill over a 10-year period. This is basically allowing nonprofit organizations to do the same. So that moves us to recent changes in US GAAP. This year was a bit of a boring year, mostly due to the COVID pandemic. There were a number of ASUs issued this year that extended other ASUs, which Jason will talk about a little bit. The first here, there was a recent change, ASU 2019-12, related to income taxes, and it just removed certain exceptions to general principles in Topic 740, and that's effective for periods beginning after December 15th, 2020 and 2021. ASU 2020-01 was a number of topics, and it clarified the interaction between Topic 321, 323, and 815. The big one there is the derivatives and hedging, and that is one of the ASUs that has been delayed, but has been out there for a number of years, Topic 815. ASU 2020-04 related to reference rate reform. This just provides practical expedience and exceptions in applying GAAP to those contracts that utilize rates that will be discontinued, like the LIBOR rate. And these are effective through December 31st, 2022. 2020-06 related to debt and derivatives and hedging. This reduces the number of accounting models for convertible debt and convertible preferred stock. And 2020-07 related to not-for-profit entities. This requires separate disclosure for contributed non-financial assets. And what non-financial assets are fixed assets or goods and services that are provided to a not-for-profit organization. And this looks to enhance the presentation and require additional disclosure of the specific types of non-financial assets, both on the statement of activity and in the footnotes. And then really quickly, just a few more potential changes to US GAAP that are coming down the pike. FASB exposure drafts, there's 4 open for comment right now, related to financial reporting, reference rate reform, improvements to lease accounting, and earnings per share improvements. Additionally, there's some other topics with potential changes. There's some crossover here with reference rate reform, leases, fair value hedges, goodwill, and liabilities and equity. So with that, it will bring us to polling question number 2, and coming out of that, I'll pass it over to Jason.
All right, thank you, Andy. As Andy mentioned, I'll be discussing some ASUs that have been deferred in 2020. Andy's already talked about audit standards that were newly applicable and accounting standards and changes to GAAP. And we'll be getting into some deferrals here, which is a bit unusual too. So the deferrals that I'll be talking about are mostly the result of the COVID pandemic and the FASB recognizing that implementing new ASUs in the midst of this crisis can be a bit difficult, and they're recognizing that and trying to give a little bit of leeway here. So the most notable ASUs that have been deferred in 2020 are the revenue recognition and the lease accounting, which are under ASC 606 and 842 respectively. Those have been deferred by ASU 2020-05. So the revenue recognition guidance was originally in ASU 2014-09, and many organizations have already implemented this guidance. Public organizations had already implemented this prior to private organizations and nonprofits being required to, but there were still some organizations that, based on their year end or based on their type of entity, had not implemented yet. And so ASU 2014-09, ASU 2020-05 adds another year to the timeline there. So the revenue recognition ASU was critical to pretty much every organization. Revenue and the recognition of revenue is critical to all companies, regardless of size, structure, nature. And GAAP and IFRS have been differing in their approach to revenue recognition, and ASU 2014-09 sought to align the two and move more towards a principle-based approach with a 5-step process for assessing contracts and the revenue recognition of those contracts. It was originally going to be effective back in 2017 for non-public companies and was deferred by 1 year by ASU 2015-14. So a lot of calendar year organizations implemented last year, but now there's an additional 1 year deferral, like I said, for any organizations that have not implemented yet. And there are, some certain industries like franchises or franchising companies that had some technical matters that they had brought to the FASB that the FASB continues to research and refine. So certainly not going back to the drawing board or anything like that, but they're refining some of the terminology in there, especially for franchise organizations. So like I said, there's a 1 year added deferral there, but early application for those impacted entities that have not implemented yet is permitted. The other ASU, or the other topic that's being deferred by ASU 2020-05 is lease accounting under topic 842. The goal of the FASB with the original ASU 2016-02 was to increase transparency and comparability among organizations by bringing all leases to the balance sheet and remove the off-balance sheet financing. It was originally going to be effective for reporting periods beginning after December 15th of 2019. It was already deferred once by ASU 2019-10 for an additional year and was going to take effect for fiscal years beginning after 12/15/2020. But ASU 2020-05 has provided for an additional 1 year deferral. And early adoption is still permitted. But most companies will likely be taking advantage of that deferral instead of trying to make that change. In November 2019, 2 additional topics had effective dates deferred. ASU 2019-10 deferred the effective dates of changes to ASC 326 for credit losses and ASC 815 for derivatives and hedging. With regard to ASU 2016-13, that was the original ASU related to credit losses. That was to take effect for periods beginning after December 15th of 2020 and has been deferred to periods beginning after December 15th of 2022 for non-public companies. Current GAAP requires that an incurred loss methodology for recognizing credit losses be used, and that delays the recognition of those credit losses until it is probable a loss has been incurred. But markets tend to devalue investments before the accounting for that loss and the reporting for that loss occurs. So this ASU attempts to align the two more closely so that decisions can be made in a more timely manner, and it reduces some of that incurred loss methodology requirement in terms of whether or not that loss is probable or not. It also delays the effective date for the elimination of step 2 of the goodwill impairment test from ASU 2017-04 to align with the credit losses treatment. And in this case, early adoption is permitted, as with the others. ASU 2017-12 related to ASC section 815 for derivatives and hedging. That was to take effect December 15th of 2019 and has been deferred to periods beginning after December 15th of 2020. Current GAAP does not permit organizations to properly recognize the economic results of its hedging strategies in its financial statements, was the response that the FASB was getting from a lot of users and preparers of financial statements. And stakeholders had pushed for improvements to the hedge accounting model to facilitate reporting that more closely reflects an entity's risk management activities. And the original ASU that has been deferred improves the financial reporting of hedging relationships to better portray the economic results and make targeted improvements to simplification of the application. And again, with this one, early adoption is permitted like the others. So that's essentially all of the ASUs that we noted as being deferred in 2019 or in 2020. And with that, I'll move into my discussion of the sustainability reporting. So for some background, sustainability reporting has been around for a while, but has expanded in practice and is likely to continue to grow in the coming years as it's being demanded by investors, governing bodies, and the public in general. Sustainability reporting is essentially the disclosure of environmental, social, and governance goals for an organization, as well as that organization's progress towards those goals. So it includes some quantitative and some qualitative information. It's not all financially driven. There are societal items in there, or impacts in there, and also environmental and governmental. So transparency continues to be a major point of emphasis just in our daily lives and in the media and from investors. And you know, that's something that corporations are dealing with, and it provides for an opportunity for organizations to provide qualitative and quantitative information to outside parties in those sustainability reports. Investors are able to use the information to maximize the social responsibility and minimize the social damage of investments, as opposed to only focusing on the financial impacts of their investments or the investments that they're targeting. The benefits of sustainability reporting include, but aren't limited to, improving or expanding the reputation of an organization, building confidence with the public or consumers, and improving innovation and risk management for the organizations. The concept of sustainability reporting has been around since the 1980s, but has grown in popularity as governing bodies and other organizations push for that transparency. With regard to the governing bodies, over the last 20 years, there have been several standard-setting bodies and reporting initiatives for sustainability reporting. If you want to move to the next slide, Andy. So you can see on this slide, there's a list of those governing bodies. Now, in that top section, those organizations or bodies focus more on ratings and measures of environmental impact. So you can see we're dealing with carbon disclosure and you know, the Dow Jones Sustainability Index. So those are more focused on certainly quantitative, but more so qualitative and also environmental items, and less so the financial impacts of those or the requirements around the reporting and the standard setting there. It's more about comparing the organizations to each other and rating them or scoring them. The bottom three organizations that I've listed here on this slide provide reporting guidance or focus more on the financial factors. And you can see they all have some sort of finance or accounting in their titles there. If you want to move to the next slide, Andy. So in terms of guidance, the IIRC released its sustainability framework back in 2013, and that framework provides guidance governing the content of an integrated report. The overall purpose of those reports is to disclose how the company is creating its value. Those integrated reports include both financial and non-financial information and include sustainability-related information in a cohesive and integrated manner so that a reader of that report is going to get an idea of those ESG items we mentioned above, the environmental, societal, and governmental items, but also financial results and financial impacts of some of those ESG items that we mentioned. The AICPA has also been involved and has a resource center that's accessible online. And in a quote from the AICPA, they stated that the development of integrated reporting is designed to enhance and consolidate existing reporting practices to move toward a reporting framework that provides the information needed to develop the global economic model to meet the challenges of the 21st century. So we'll talk a little bit more about the challenges of this reporting in an upcoming slide. And certainly there are big benefits to this reporting to organizations, but it's also not a small undertaking. There are a lot of challenges that come along with it. In addition, in 2017, the AICPA issued attestation engagements on sustainability information. And the guide applies when a CPA is performing an exam or a review pertaining to the sustainability information. And the auditing or reviewing of sustainability reports is an opportunity for growth in public accounting, and it's likely an area that mostly large organizations are dealing with at the moment, but there's always going to be that trickle-down effect where anything that the large corporations are being pushed to do is at some point going to make its way down to the small and mid-sized organizations. You know, stakeholders will be looking for that transparency. In terms of the current state of reporting, if you want to move to the next slide, Andy. Sustainability investing has been growing in popularity, like I mentioned, but there's a lack of standardization in the sustainability reporting, and that poses a big challenge to the organizations that are presenting the information, the users of it, and also the preparers of that information. Currently, in the United States, sustainability reporting is mostly voluntary, but corporations have increased their reporting on these issues, and they're seeking to provide more transparency, especially where it benefits them, to potential investors and the public at large. There are more requirements to report this information in the European Union and in other countries throughout the world. According to a 2017 study, approximately 83% of N100 companies in North America issued sustainability reports in some form or fashion during 2017, which is compared to less than 20% of that same group of companies in 2011. Those N100 classified companies are essentially the top 100 companies simply based on revenue across 49 countries in various industries. So it's certainly something that's taken hold with larger organizations. And there was a recent article in the Journal of Accountancy that talked about the states of board of directors and their focus on societal and environmental issues, where it indicated that 84% of board of directors members said that companies need to do more to promote gender and racial diversity. 39% said that executive compensation should be linked to some sort of diversity or environmental goals. 67% thought that climate change should be part of a company's strategy, and that's an increase of 13% just from last year. So those are some of the things that investors and people that are running these companies that are on the board of directors are looking at and see as something that's valuable both internally and externally. While the number of companies domestically and worldwide continue to increase, there still needs to be more work done towards improving the quality of the reporting because there's no one set governing body. You know, there was that previous slide where we had 6 different groups that are essentially, you know, handling the reporting and the ranking, but there is no one set governing body at the moment or one set of standards. So research has found that in many cases, sustainability reports lack focus on the sustainability issues that are most important to the investors. There's certainly information in these reports, but it's not in a format or it's not in enough level of detail to be very meaningful to some of the investors or the users of that information. The SASB notes that most companies continue to take a minimally compliant approach to sustainability disclosure, providing the market with information that is inadequate for making good investment decisions. So there's a demand for more consistency and comparability from both users, preparers, and the governing bodies. And there's a desire to have as many shared general features across those sustainability reports so that you can compare within a given industry, but also on a more broad strategic framework for comparing, you know, other companies across industries. So I mentioned before that there are certainly some challenges with regard to sustainability reporting. And if you want to move up, I think a slide or two, there it is. So like I mentioned, many challenges exist to setting up a truly robust and thorough system for sustainability reporting. Right now, there are a lot of competing frameworks. There are broad frameworks, industry-specific frameworks, and then also differences between domestic and international reporting and treatments. There's an absence of uniform reporting standards. There's nothing similar to SEC reporting standards or GAAP standards for sustainability reporting at the moment. And the measures and units of measure are not standard across industries or reporting regions. There are different measures of materiality and different ways that uncertainty is measured. You know, sustainability metrics can't be measured with a high degree of accuracy either, which is difficult for accountants. You know, we're used to things that are relatively black and white, and we're dealing with quantitative but also qualitative information, and a lot of the sustainability reporting information is more on the qualitative side of things or is open to interpretation. There are also inconsistent reporting measures and boilerplate language that is difficult for investors to deal with or users of the sustainability reports to deal with. And like I mentioned before, it's difficult to compare companies, and there's a disparity between what the company views as important and should be included in the sustainability report versus what the investor wants to see. If you want to move to the next slide, Andy. Oh, I apologize. So I thought I had one more. So in conclusion, you know, regardless of the challenges, these issues also represent opportunities for these companies and for accountants and auditors. Like I mentioned before, it's mostly an issue for large companies at the moment, but it will likely trickle down. It's an area that has significant potential for growth in the coming years. Those percentages I mentioned before in terms of the number of companies that are preparing these reports are likely to rise in those large companies, and accountants will see the impact in the coming years as reporting changes and becomes more widespread. And also, at some point, there will likely be some sort of governing body or reporting body that's putting out standards for sustainability reporting. And with that, that concludes my discussion on sustainability reporting. There's a next polling question is up in front of you, and then Jeff will be picking up from here on, talking about GAAP accounting for PPP loans and going concern considerations in light of COVID. Thank you.
All right, is this my cue? I trust everybody's had an opportunity to get through the polling question, and thank you, Jason. Really a new and potentially interesting area with the sustainability accounting and reporting. We're going to talk a little bit, as Jason mentioned, about GAAP accounting for PPP loans. So we move to the next slide, we highlight a few things. We think that at this point, everybody, or at least everybody that's going for continuing education credit and as a CPA is aware of the Paycheck Protection Program and is aware of the PPP loans. Nevertheless, even though this is old news at this point, there remains confusion as to the treatment of those loans, both from a GAAP standpoint and a tax standpoint. This will be an issue for each GAAP and tax for 20 and 21 both. We're focused on the 20 and 21 reporting. So we move to the next slide. We're focusing on GAAP for a number of reasons, and we're opting to avoid talking about tax because of the fact that the tax has been thoroughly covered in other presentations. In fact, it'll be covered again in the December 17th presentation that Mary Lou mentioned. As many of you have noticed, the tax treatment is a moving target, and we're going to talk about that with regard to tax provisions in a couple of slides. To keep abreast of that, please check back frequently to our Coronavirus Resource Center at GYF.com for more information. That is updated really as the news comes out, sometimes several times a week, and sometimes it will go several days between updates, but I can assure you it's highly current because we have several people following that very, very closely. So we move to guidance on the PPP loan accounting. It's important to note several things. First of all, in changing the order of the bullet points, there's no pre-existing guidance that exactly fits. It's become overused to say that this is a novel situation, a unique situation, but from a reporting standpoint and even from a PPP program standpoint, it is new. So no historical guidance exactly fits. The FASB has not spoken. There is guidance that has come out really from several sources, and it really is pretty harmonious, whether it's from the AICPA or the SEC or the Center for Plain English Accounting and so forth. There's typically been articulated 2 to 4 recommended approaches to accounting for PPP loans. We're going to focus on the 2 that are embraced by the SEC and the PICP and the AICPA. They may be superseded. The odds of that are diminishing as time goes on, but this guidance has not yet been superseded. So we're going to talk about that guidance now. And we're going to talk about the 2 acceptable treatments. Recognize that there are 2 acceptable treatments. You may evaluate them, but there are 2, at least at this moment, theoretically equally acceptable approaches that one can take in financial reporting. Each of these approaches takes an analogous approach in looking at historical guidance. As I mentioned a moment ago, there was nothing in the existing literature that exactly fit this situation. So they took an analogous approach. As Mark Twain indicated so aptly, history doesn't repeat itself, but it sure does rhyme. So while this has never happened before, it does rhyme with some things that have been dealt with. It's important to note that this applies both to nonprofit and for-profit entities alike in an equal depth. It's important to assess your particular situation when choosing the best approach. Look at the best approach for your circumstances at a particular point in time in considering the nature of your entity, where you stand at the moment that you're reporting, and the likely users of your financial information. Now we're going to look at the 2 models. There are 2 models that we wanted to highlight, as I mentioned, and the 2 that are most embraced. That would be the government grant model, which is analogous to the ASC 958-605. Now, some of you GAAP wonks will already be noting in the chat section that relates to nonprofit entities. Well, the analogous part is that the advisors with regard to the guidance have said, yes, we're going to draw a for-profit analogy to this nonprofit guidance for grants, the 958-605. There's also the debt model. The debt model is analogous to the debt section in the codification, ASC 470. It's interesting to note that the treatment of the forgiveness in each case will be below the line. It will be in the other income and expense category. Much less important for a nonprofit, but even nonprofits reflect the difference between operating income and non-operating income, and this will be below the operating line. We're going to talk more specifically now about the grant model. What's intended in the grant model for both for-profit and nonprofit entities would be to recognize the forgiveness of the PPP, or actually the recording of the PPP loan and the forgiveness, similar to the nonprofit contribution guidance. The nonprofit contribution guidance has been very clear that it does not include government grants. However, it has historically indicated that debt forgiveness would be defined as a contribution under that guidance. So in pushing the analogy, the outcome is that one would recognize the PPC proceeds as income as a high confidence level of forgiveness is achieved. As a company progresses through the spending of the qualified expenses, the money on the payroll, on the allowed lease expenses, and all the other things, as one achieves a high confidence level of forgiveness, one would then progressively recognize the income, once again in the other income category. What does that mean for T accounts or debits and credits? Well, the next slide will give a little light on that subject. What do we do when the proceeds are received? Well, I think everybody, even those who probably haven't even thought about taking the exam, would recognize that when we receive the cash, the first step is to debit cash. That's actually probably my favorite part of any accounting day. Debiting cash tends to be a happy day for most entities. The credit would be to a deferred PPP grant. Remember, we're taking a deferred grant approach to accounting under this model. So the credit would be to a deferred PPP grant, which is a liability, of course. Upon achieving the eligible spending, achieving eligible spending equals high confidence. Remember, embedded in that is the assumption that you did your application in good faith and all those other things, and that you don't have a high concern that your application would be rejected when it's ultimately submitted to the bank and to the SBA. Upon achieving the eligible spending, one would then debit that deferred PPP grant liability, and the company would then credit PPP grant income. Once again, and I'll repeat it until you're tired of hearing it, in the other income category of your income statement or statement of operations or statement of activities. So a pretty straightforward approach. The challenge there is in actually measuring how well you've progressed in the spending of the eligible expenses. That should be easy for most. And I think Dawn, Mike, and Bob have indicated in a prior slide on the tax side, one should load up those expenses. It's okay to spend way above and put in your application expenses well beyond the amount of the PPP loan that you applied for and were awarded. So that would be the actual exercise, the actual Excel model that would be orchestrated. And of course, always remembering to be sure that you don't have a high risk of rejection. Moving to the debt model. The debt model is blessedly simple. It follows a traditional debt model. Interestingly, it does record one, as would be true or analogous with a debt model, to accrue interest, to record interest as you go, and to reflect the cancellation when the process is complete. And those that have looked at cancellation of debt income for other matters would recognize it's really not reflected until it is complete, until using another analogy to the 606 literature, until the loop is complete, until the interaction is complete and is no longer in question. That's when we would reflect the income. Moving to the debits and credits of that model, in the next slide, we once again see the debiting of cash, of course, but this time the credit is just a little bit different. The credit is the PPP notes payable, or PPP note payable if you have only one of them, rather than to a deferred grant. Upon forgiveness, we of course debit the note payable, and we recognize the gain on PPP loan extinguishment. It's a nuanced terminology from the PPP grant income. They're both in your other income and expense. Most non-CPA readers might not know the difference between PPP grant income and gain on loan extinguishment. They'll land in the same place, but it's helpful to be consistent with whichever model you choose. How about considerations for choosing between the two models? Well, it's important to have the proper disclosures in either case. Proper disclosures are always important, maybe particularly so here. I think in most cases, it's helpful to note and very important to note that most readers will be equally informed regardless of which method, which model a reporting entity chooses. If the disclosures are adequate the disclosure indicates the fact that a company received the loan and indicates the method of accounting for it. And if it's the deferred grant model, indicates the anticipation of forgiveness and the progress against that forgiveness. Or if it's the debt model, indicates some expectation that ultimately it will be forgiven and that accounting will be reflected in the period of the forgiveness. I think then in those cases, either method is perfectly fine and really isn't worthy of too much debate. They do have some different merits, particularly if you like to debate the technical merits of either one. Those who were actually authoring it commented on the fact that the debt model would be a little more appropriate, or a lot more appropriate perhaps, for cases where there was meaningful risk of lack of forgiveness for some substantial amount, all or part of the PPP loan. Early on, and in fact when this guidance was actually issued, there was a lot more concern about the likelihood of forgiveness of the PPP loans. We were still in the 8-week measurement zone and all of those other things that have largely been loosened up, as you've heard in the tax presentations on the PPP. Nevertheless, this remains an absolutely acceptable method, particularly with the appropriate disclosures. With regard to the deferred grant model, those who really are advocates of that cite the fact that it is more closer in economic substance to two things. It's more closely resembling the intent of Congress in that these were intended to be forgiven in large measure. Something at least $1 more than 50% of the PPP loans were expected to be forgiven. Secondly, when one looks at the forgiveness application, granted it came out after this guidance, because it wasn't issued until August of 2020, the actual application process allows for the tallying of the spending and so forth, which makes it pretty clear that if one follows the guidance, one will very likely achieve forgiveness. So those advocates cite the economic substance of the approach. It doesn't matter which of those camps wins, they're both acceptable. With a caveat, of course, when you have a transaction situation or something else where the timing of the recognition would be of particular importance. Dawn mentioned on the tax side several instances where we worked, and several of them together between he and I, where there is a transaction in play. The transaction may actually be intended to close before the I's are dotted and T's are crossed, before the SBA awards final accounting for this. It's important in that case to be extremely careful in how this is looked at, how it's carved out, or how it may be dealt with in other ways. Impact on EBITDA and covenants is also critically important. Most banks have basically reflected the fact that while this is below the line, the fact that the related expenses, payroll and whatnot, are above the line requires it, or at least suggests that it should be not punitive to EBITDA. In almost every case that I'm aware of, a recent exception has come up, the banks have reflected one method or another to not be punitive on the covenant side. Impact on tax provisions is likely to be solved really as the moving target starts to move a little less frequently. We would like to see some resolution of the deductibility of those expenses before we have financial statement issuance dates in the spring of 2021. Stay tuned. Hopefully they'll have some important news on that in December 17th or January or whatever. So stay tuned on that, and by all means, be in touch with your GYF executive if you have any questions on the tax or the gap side of the PPP. We're going to move now in our last handful of minutes to going concern considerations in a COVID world. It's a big deal in spite of the 3 minutes that I'm allowing for it. So we move to the first slide, the next slide actually. It's always an important situation. There are always uncertainties. There are clearly more of them now that impact more industries. The assessment may be more challenging now than in ordinary times because these are not ordinary times. Nevertheless, we can't just blame COVID and avoid an assessment of our ability to continue as a going concern. We still must assess. We still must look at it for 12 months from the date of issuance of the financial statements. It's still management's responsibility. It's the auditor's responsibility to audit management's assertion. Next slide. And the things that are most important to consider here are differentiating between impairment and distress. They are different concepts. They are different dynamics. even though the hospitality industry will be decimated, not every restaurant will fail, but many are in distress. Those that are not in distress may or may not have an impairment of their furniture and fixtures, etc. So impairment and distress is an important differentiating factor. Declines below market value may just reflect impairment issues. They may be pandemic related or they may not be. They are not necessarily indicative of a going concern issue. Next slide. When looking at the going concern issues, look at your ability to pay current obligations. Look at an entity's ability to maintain production. Can they still make their stuff? Can they still get their raw materials? Do they have labor? Are they allowed to have customers come in the door? Can they generate revenues, or are they shut down by a governmental entity? The standard things that one looks at, but usually one doesn't have to worry about availability of supply. Now we do. Next slide. With the assessment, and I'm going to talk a little faster right now, we're going to look at whether revenue declines are temporary. What's management's best estimate of whether the declines are permanent or temporary? Will they come back? Will people return to downtown office environments? Is the margin erosion permanent or temporary? Has there been margin erosion? Have there been disruptions in the supply chain or labor disruptions? What's the viability of management's mitigation plan? Every management team has a story. Do they hold water? Do they have ability to raise money? Have they availed themselves of various government relief programs? Are they continuing to evaluate their options under other ones? Do they have a punitive or difficult debt structure or covenants? And if they do they have a good rapport with, and are they working with their lenders and others in that regard, in that area? My last slide will be what to do if the uncertainty persists. Well, two choices really. Reflect the going concern uncertainty in the financial statements in the auditor's opinion, or hold off issuance until uncertainty is resolved. Many will be doing that. It's again your choice based on your individual situation. And there's an audit standard reference for what to do when you have a protracted delay in issuing financial statements. This has been embraced both in the United States and really across the world in the international standard setters. It's an important matter. If you're making plexiglass, it's a non-issue. If you're in the hospitality industry, it will require meaningful consideration. In conclusion, Mary Lou's highlighted several things. Next slide, please, Andy. We have information for which to submit questions, not only in the chat and the Q&A section here, but also by email to Jason, Andy, or myself. Once again, we appreciate the time, and we will move to the evaluation survey that Mary Lou had mentioned, and that survey will take the place of our final polling question. We will then have a brief intermission, and I'll jump back on to introduce the pre-recorded session by Mark Wollstonecroft and Megan Troxel. Thank you.